Welcome to Nasdaq TradeTalks, where we meet with the top thought leaders and strategists in emerging technologies, digital assets, and regulatory landscape and capital markets. I'm your host, Jill Malandrino, and joining me on the desk at the Nasdaq market site is Simeon Hyman, Global Investment Strategist of ProShares, Taylor Ranney, Senior Vice President of Business Development at RecShares, Kevin Rich, Chief Operating Officer of Webb's Investments, and Brett Sheely, Head of ETF Specialists at AllianceBernstein. We're here to discuss options-based strategies in ETF wrapper and the role of retail investors in ETF launch dynamics. It is great to have all of you with us. Certainly a lot to unpack here. Kevin, let's start with the basics here. The role of derivatives in investment portfolios. Why derivatives?
Well, derivatives are great products for giving access to asset classes that are hard to reach. Options give you the ability to generate income, set floors, caps on things. Total return swaps are a great way to get the total return. Capture an asset class, include the dividends, things like that, sometimes preferential tax treatment. So if you look at derivatives as tools in your toolbox, options, swaps, futures all play different roles.
Right, and Simeon, having it within that ETF wrapper certainly makes it more accessible.
Absolutely, this is part of the democratization that we've all been talking about. Many of these strategies existed in institutional vehicles or structured products, and the ability to put them in an ETF such that people can just have them in their brokerage account and trade them as any other ticker just makes it very convenient to deploy a lot of these strategies.
I would add too that the options market and derivatives provide liquidity, right? Which is important when you're thinking about launching a product in an ETF wrapper. You're getting the on-exchange liquidity. You also need that underlying market liquidity, which derivatives can provide, especially into some areas of the market that are otherwise less liquid.
Yeah, that's a good point that you make. Taylor, when you think about covered call ETF, single stock versus index level volatility, what's the distinction there?
Yeah, so that's basically why we designed the products the way we did, is the idea that implied volatility can be meaningfully higher at the single stock level than it is at the index level, right? You can have diversification benefits if you own the underlying index or if you own all of the constituents of an underlying index, but when it comes to actually writing calls and capturing premium, that's driven massively by the level of implied volatility. And so if you can capture that from individual securities, then you're able to not only capture higher premiums, but you can also write the calls further out of the money, which doesn't cap your upside as much.
Yeah, well, speaking of indexes, Simeon, IQQQ, the Nasdaq 100 High Income ETF, which celebrates a year, which is exciting. Why are investors drawn to that?
This is roughly the 1-year anniversary, and exactly as you were talking about, there are challenges with traditional covered call strategies. Traditionally, you do them on a monthly basis, and you were selling away the upside of your stock. So traditional covered call strategies have only delivered maybe 1/3 to 1/2 of the return of equity markets. But as many of us have heard over and over again in the news, there are now daily options on many of the main indices, particularly including the Nasdaq 100. That allows for a covered call strategy that's executed on a daily basis through daily option strategy. And once you do it every day, you can get the income that you're looking for, but also fully participate over time in equity markets. So far, so good. IQQQ is running right alongside the Nasdaq 100, and it's got a trailing yield of about 9% and change.
Yeah,
and that's very attractive.
Well, it certainly is attractive. And Kevin, when you think about the environment that we're in now, which is more prolonged volatility than we may necessarily be used to,
Yes.
It kind of makes sense to talk about these strategies.
Yeah, no, it's a very choppy market, and it's hard to get direction right now. I work at Webb's Investments, and we just launched 2 products in December that try to target volatility. So if you're in a low vol environment, we step on the gas a little bit to give you more returns. And when you're in a high vol, we back up and go more to cash. But in a market like this, day to day, the vol is all over the place. So we need to see kind of government policy and some things settle down before we see what the direction for the rest of the year is, I think.
Yeah, I mean, when you think about returns longer term as well, I mean, you can only get 25% returns year after year for so long. We were talking about this off camera before. 7%, 8% is not a bad average when you think about it historically.
No, I agree. But what we're seeing right now with market volatility, I mean, we're hitting levels we haven't seen since 2022. So I can see why investors are now thinking, okay, let me look at the volatility that's in my portfolio. Maybe I'm not going to get that 25%. Maybe I'll be lucky to get that 7% average. So how should I think about positioning for volatility in my portfolio? That's why, at least at AllianceBernstein, we've brought out a suite of buffered ETFs, which really provide downside protection with an upside cap so that you can start to manage for that kind of intra-period volatility without giving up kind of the upside opportunity that you want to get from your equities.
Yeah. When you, Teller, when you think about the retail and advisor environment, would you consider that the same thing, not necessarily institutional? How are they approaching this?
Yeah, I mean, to start by differentiating, you have institutional, you have the advisor community, and then you can call retail advisor, or you can call it the actual end user. And I think what's really interesting that's happened since really COVID is the idea that the end user, the end investor, has actually become much more impactful when it comes to how they're allocating money. They have access to apps, and they have access to institutional quality strategies through the ETF structure like we're talking about today. But the catch-22 that we've all had to experience is a long-term process to raise assets and to get a track record and build that track record to then get on platforms and get more access to advisors. Retail is now kind of becoming that first to market and providing that opportunity to bring those products to scale.
Yeah, which is interesting because you told us an anecdote earlier about how long it would take to get an ETF that has an options component to it.
Yeah, no, after the financial crisis in 2009, I left Deutsche Bank and started my own firm, and I filed a couple ETFs with the SEC, and they were stuck for like 3 to 4 years before I could get approval, and they were options-based strategies, and now those you can bring to market in 75 days. So the whole industry has come a long way.
Yeah, I mean, it's really not that, 15, 16 years? That's remarkable progress for it to move along that fast.
And even thinking about the ETF rule in 2019, that brought active management into the ETF wrapper, creating a streamlined process. So rather than seeking like exemptive relief from the regulators, you now have one process everyone can follow to bring strategies out into the marketplace in the ETF wrapper, which they desire. And I think that's just made a much more consistent operating environment for asset managers.
I think it's more efficient for investors too at the end of the day. I mean, when you think about the liquidity behind it, the tax benefits and so forth, it seems more convenient than having it, kind of all over the place and not under one umbrella.
Yeah, it really is an efficient solution to folks. And I wanted to get back to your comment on volatility, because this is an environment where sometimes for the first time in a few years, people are really looking at the components of their portfolio. And one of the things we've been noting is just the notion that, to some extent, this is an environment where you can let your stocks be stocks and your bonds be bonds. Quantitative easing is ended. So, for example, if you look at a traditional monthly covered call strategy, people think it offers downside protection. Downright with the market. The market doesn't go down 2% a month for 5 months. No, it goes kaboom. And if it's down 10% in a month and you got 1% premium, you're down 90%, which is the history of the down capture of a monthly strategy. Now, with a daily strategy, you're going to perform right with the Nasdaq 100 in the case of IQQQ. But why that's interesting right now is, what's in the green year to date? The aggregate bond index. So for the first time, people shouldn't forget that the 60-40 portfolio can do its job, because we don't have a 50 basis point yield on the 10-year Treasury anymore.
Yeah, it sounds like these types of products would be appropriate for an allocation in an investor portfolio in any environment. I mean, there's always going to be that search for income.
The asset allocation decision is a super important one. One of the things that we love about a daily option strategy is it's going to behave like equity, so it goes in the equity bucket. Some of the other strategies kind of got to think, do I want to put it in the alts bucket? Right. Do I fund it half from stocks, half from bonds? But it is a very important question in managing your overall risk profile.
Yeah,
I think that's a great point, because just because you have all these derivatives doesn't mean they're always appropriate. And, we have a lot of product innovators in this industry, so there's going to be a lot of products that come out. But like, I worked with gold producers and gold ETFs for a while, and people would always say, well, why don't we do a buy right on gold? I say, well, the vol's not that high, and you want your gold when things go wrong. You don't want to have someone take it away from you on your call. So there's just because you can do a buy right on certain assets doesn't mean you should always.
Yeah, so it's interesting, Brett, because it's great to have all this innovation within this space, but I also think that the industry needs to focus on educating what the underlying is particularly when we think about alts. Those liquidity profiles are a little bit different.
They can be. But I do want us to go back to kind of 2022, right, where the 60-40 didn't really work. Right? The balanced portfolio didn't work.
That is the scar that everybody has.
And it's a recent scar, right? It's only 2025.
But that's why you're seeing that demand for the alts.
And that's why we're seeing demand for alts. But then you also have to consider, okay, what is an appropriate allocation to alts, and how should you consider the role of alternatives? If I think about buffered ETF strategies, like, yes, they are an alternative allocation. They have low correlation to U.S. equities and really no correlation to bonds. So they provide a nice diversification benefit within a portfolio. And we think that is something that can be an evergreen strategy. But also you're not sacrificing, let's say, liquidity because you're putting this in an ETF wrapper the way you may have to with other illiquid alternative products.
Yeah, it's interesting. Taylor, you have a product here, the Bitcoin Corporate Treasury Convertible Bond ETF. So it kind of sounds alt-ish in a way.
Alt-ish, also somewhat tangentially option related in the fact that convertible bonds have a conversion price. So you get the downside protection from the principal repayment at maturity if conversion price isn't met. And so you have an asymmetric return profile. So that's a particularly interesting product. We launched last Friday, actually, called BMAX. And it is focused on convertible bonds that were issued by companies like Strategy, who issue converts to fund purchases of Bitcoin for their corporate treasuries.
Yes, which I think a little bit different of a subject, but that it's an interesting financial engineering exercise.
Yeah, it's companies that are restructuring how they think about their corporate treasury.
Right.
They're trying to incorporate a long-term asset that they believe is going to have substantial room for growth in the future, and they're able to issue these bonds at 0, 1, 2% to acquire Bitcoin. And so you have, again, asymmetric return profile. These convertible bonds thus far have outperformed Bitcoin since they've been launched. So you have companies like Strategy, which are 1.5 beta to actual Bitcoin. So that's a levered play. Then you can kind of have this type of portfolio, which is a slightly differentiated version without buying actual Bitcoin.
Yeah.
But again, somewhat options related in the fact that there is effectively a call through the conversion price.
Yeah, it makes you wonder the interest rate environment, how that could potentially impact some of these strategies.
To me, it comes back to the investment policy statement. That's got to be your true north. And it encompasses, do I think 2022 will happen again? Oh, okay, there was a bond rally and tariffs might be coming. So I think the base case is maybe interest rates will rise and my longer duration bonds are at risk, except that long duration bonds are the precise thing that will diversify me if there's a recession. So do I need a barbell? And you have to make these decisions so that you can make a very conscious decision of the buffers go in the alts bucket, and I used to have 5% in there, but I think 2022 might happen, so I'll have 10, and I want daily covered calls in the equity bucket because I feel okay about equities. All of these are guided by an investment policy statement, an asset allocation, and a tactical asset.
Right, and this is an environment that we haven't seen because of the liquidity that was so flush in the market. You have to play these 4D chess games. and this comes back to active management and why trying to replicate that on your own as an individual investor, not only is it inefficient, it's not easy to do.
Yeah, and I think going back to asset allocation decisions are so critical. It's a big driver, the largest driver of return, right, for any portfolio. And I'd say within the buffered space and how we think about that, our largest investor in our buffered strategies is using our BUFC, our conservative buffer product listed on Nasdaq, as a core component within their central advice model. And so that is being used for the sole purpose within their asset allocation to reduce volatility for investors who are seeking that, right? These are folks who are maybe in retirement, near retirement. They have less risk appetite than they did previously. So they say, I want a lower volatility option. Okay, we're going to take part of your S&P 500 exposure. We're going to put that into a conservative buffer product. That, when you think about the whole portfolio allocation, now reduces your total drawdown risk. It reduces the volatility you're experiencing day in and day out. We think it's a better tool for investors.
Well, I mean, it makes sense, especially when you're thinking about that demographic. You want predictable results, right? It's not like in your 20s and you can kind of, ride out some of these machinations, which comes back to one of the points that you had made, making sure that you're choosing the right tool and the right product and doing the research behind it.
Yeah, absolutely. And I probably have more gray hair than almost everyone here.
I
lived through the 87 crash. And, you saw people buying puts after the 87 crash because they were just, in shock. And it's kind of like, you should have a basement in case there's a tornado, but you shouldn't live in your basement. I think you can't, you got to recognize that over a long period of time, your equities are really going to run, and you don't want to, you don't want to hamper them down by kind of cutting off their returns. So I think it's important to keep perspective especially in a time like this.
Yeah, and it's a great point that Kevin makes, Taylor. We also have recency bias, right? Where buying the dip was the thing for a number of years, and now you have to exercise your mind in a very different way, where patience could be a virtue, and it's just it's a different environment. You have to consider your portfolio from that perspective.
Yeah, I think everybody's hit on asset allocation. Every single time I talk to a client, every conversation ends at portfolio fit. Where does this fit into the portfolio? What's the funding source? How am I supposed to think about using that? And at the end of the day, it's a different conversation with every single client. And one point we made about client demographics is around tax consequences, and I think that's a really interesting point to think about within at least the covered call space. Return of capital is an often misunderstood idea within the covered call ETF structure. It gets a bad rap, but what actually happens is your tax or your distributions are tax deferred, right? And your cost basis is actually reduced, meaning that you can have tax deferred growth from an income perspective, which is really unique within this space.
And that's because of the ETF.
Yeah, if you're buying options or you're writing calls on your own, that's going to be classified typically as ordinary income.
Yeah.
So if you're talking about holding that for 1 year or more, you have 50 or 20% long-term capital gains tax.
Yeah.
Only at the point in which you sell,
which is a great point, Simeon, that Taylor makes here. Understanding all of those nuances and how this has led with so much innovation within the ETF space, it gives you more options. Pardon the pun, as an investor.
You do have to do a little bit more work, and I think all of us at this table, I'm sure, are dedicated to the education piece because they aren't plain vanilla solutions. But it's all there, on our site, and I'm sure as the rest of everybody on the table, the holdings are transparent, the education is there, and people should just make sure that they understand what's in the ETFs.
I'd say it's also educating the educators because sometimes the FINRA notices I see or the what certain wirehouses are calling complex products. I think that's not a complex product, and so I think there's education all the way around.
Yeah.
And that's a huge part, all of us, huge part of our jobs. But to your point on the wirehouses and some of the key gatekeepers and research teams at the big wealth distributors who are then interacting with financial advisors all day long, they are being pinged with questions on these products all day long, and they are kind of getting comfortable themselves with how the products work, how they work within an asset allocation structure, so they can provide that advice back out to financial advisors. That space is changing so quickly because everyone's getting up to speed now. It
is changing, but one thing that hasn't changed is that the narrative, the story to the end user still has to be digestible. So the gatekeepers and the educators of the educators, it's our job not just for them to understand the technical aspects, but to be able to retell the story. Yeah. Even in our index-based plain vanilla equity strategies, like our dividend growth strategies, we put forth single stock highlights because even though it's an index-based strategy, people like to tell stock stories. Yeah. And they want to be able to communicate the narrative of why these derivative-based solutions are doing something different in the portfolio.
And there's a really nice balance that you have to strike because, yes, they can be overly complex, but you don't want to overcomplicate them, right? In our kind of flagship covered call strategy, we hold 15 individual stocks and we write calls on 100% of each of those. It's relatively straightforward, and if you talk to gatekeepers and you talk to people who are on the due diligence teams, you don't want them to, right? S&P 500 is available for people to buy, obviously, right, through various vehicles. If you have a covered call or a buffered strategy, you have a lower beta access to that same index or asset class. And so, in my opinion, it shouldn't be overcomplicated, but it needs to be simplified enough so that advisors know what they're buying.
I feel like we're talking about it's the use cases,
yeah.
Right? It's what role do these products play within your portfolio, within your asset allocation? And there's going to be, 3 or 4 that really resonate with end investors and with financial advisors, and it's really getting those folks comfortable with those use cases. You don't need to be an options expert to understand how to use buffered ETFs.
Yeah. Well, to wrap up here, and I'm going to take the last couple seconds that we do have, it's any industry. That's great advice for any industry. You have to know your audience, right? Say you're in cybersecurity space, you have to understand how to talk to the board, how to talk to compliance, how to talk to the marketers, how to talk to your sales teams. So I think it's great advice that you all laid out. Regardless of what space you represent. Appreciate everyone's insight. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.